Welcome back to another TechnoloTrade video. In this video, I'm going to show you how and why to use options as a stock replacement. So let's go ahead and jump into it. We're using Apple as our example here, and I'm going to be playing with the options here with 36 days to go. So let's go ahead and do it. Let's say we wanted to get long 100 shares of Apple. So if we were just to buy the stock, 100 shares of Apple right now at the market would reduce our buying power $6,596. So it would cost us $6,600 to put on that trade for 100 shares. So the stock shares have a delta of 100. So every dollar the stock goes up 100 shares, you're going to make $100. You're going to make $1 per share. So for $6,000, $6,600, you can get 100 shares, and every dollar it goes up, you make $100. Now, in option terms, you could buy to get the same effect of buying around the 132. You could buy an in-the-money call. So let's go right here with this one with 71 deltas. So if you bought one of these, let's go down one more actually, 75 deltas. So if you bought one of these, your break even is going to be 125 plus the 875, so 133.75. So you're paying a little bit more, so your break even is going to be up here, but instead of needing $6,600 to put on the trade, this trade only requires the $875 you used to buy one contract, which is equal to 100 shares. Now, the difference is between straight up buying stock and buying an in-the-money call equivalent. Besides the huge reduction in buying power, if you bought 100 shares of stock, you'd need $6,600. If you bought one in-the-money call contract, this example, you're only paying $875. So essentially, you're covered to the downside. So if this were to fall out of bed, you could potentially lose $6,600 if it fell to zero. But with calls, you're only going to be eligible for that $875 for that contract. Now the difference is, though, with straight stock, every $1 it moves up, if you have 100 shares, you're going to make $100. Now, this is different. This only has a 74 delta. So with this call contract, with every dollar the stock moves up, this one contract is only going to gain $74. So essentially, what we have here is you're getting 74% of the move. You can take advantage of 74% of the move, the price move, for fractions. Putting up fractions, $6,600 compared to $875. So let me bust out a calculator. So we're looking at 875. So you're getting 75% of the price move for putting up 13% of the capital. So that's why calls can be used as a stock replacement. Now, this is obviously a bullish play. You wouldn't buy a stock unless you thought it was going up. You wouldn't buy a call unless you thought it was going up. With puts, it's just the opposite. So, if I thought Apple was going down, I would either sell 100 shares, which would give me, for every dollar it went down, I'd make $100. Or I'd come somewhere around here to the same deltas, and in the money put. I could get it in the money put for $7.70, and I'd be collecting 73% of that move, compared to if I were to sell and at the market $6,600. So there you go. That's just a quick overview on why and how to use options as a stock replacement. The main takeaway is you can capture high quantities of the move, in this case 74% of the price move if you would have bought in the stock, for 13% of the capital required. So this is also great for limiting downside. I mean, it's a lot easier to know that if you have one call contract on, you know, your max loss is $875. That's a lot easier to take than having 100 shares on, where your max loss is $6,600. And, you know, that gets scary. With something this small, you know, it's a lot easier to take the heat and just let it ride. So I hope this helped you out. That's using options in place of stock. Alright guys, thanks.